Good evening, everyone. Today I'm going to explain why college students should start investing before age 20. Many people think investing is something you do after college or once you have a stable career, but I am going to show you why waiting can cost you one of the biggest financial advantages you will ever have, which is time. Starting 10 years late can cost you $50,000. I want you to look at this example. This investor starts with an initial investment of $2,000 and contributes $300 per month at a 7% annual return rate. There is nothing unrealistic about these numbers, but over time, the growth becomes dramatic. This happens because of compound interest. Earnings generate more earnings each year, and that goes year after year. The key factor isn't just the money, the time the money has to grow. That is the factor. My argument is simple. College students should begin investing before age 20, even if it's a small amount, because time is the most powerful financial advantage we will ever have, and starting early builds long-term financial security. Now, a main issue that goes on with young people and also seasoned investors is financial illiteracy, and that is a major problem. One major reason students delay investing is financial illiteracy. According to the FINRA, Investor Education Foundation, many young adults struggle to answer basic financial literacy questions. A lot of students don't fully understand compound interest or long-term investing, and because of that, they underestimate how important it is to start early. Now we go to slide 5, and this is the cost of waiting. We see Tabitha on the left. She invests $50,000 at a 10%, and that becomes $1 million, well, almost $2 million. And she is, in fact, an early saver. Now we see Tanya on the right side, and she invests a lot in her later peak career. And she invests $100,000 at 10%, and it only becomes $600,000. And then we see that one starts young with less, and then one starts later in more seasoned career with more money. But yet we see that the person who starts earlier capitalizes on that opportunity and receives more rewarding benefit. Now we see the power of compound interest. This growth happens because of compound interest. Compound interest means your returns start earning returns. And according to the US Securities and Exchange Commission's, compound growth builds on both your original investment and your accumulating earnings. The earlier you begin, the longer that cycle continues, and that's where the real wealth is built. And here we just have a little graph. Now there's objections. One objection is, well, I don't have any money. A common objection is that, hey, I'm in college or I'm in high school, I'm not working, I don't have any extra money. But investing doesn't require thousands of dollars. Starting with 25 or maybe 50 per month is very achievable, and it's possible. It's less about the size of the investment and more about building the habit early. Small, consistent investing creates powerful long-term results. Now we go into the 8th objection. Investing is too risky, and that's a very valid concern. Yes, markets go up and down in the short term, but historical data from S&P Dow Jones indices shows that over long periods, the stock market has trended upward. Diversified index funds reduced risk by separating investments across many companies. The longer you stay invested, the more stable returns become. And here's another objection. I'll start later. Some students think they'll just start investing once they graduate, but delaying means losing valuable growth years. If you wait, you'll have to invest much more later to catch up. Starting early lowers financial pressure in the future and gives you flexibility. Now, what's the solution? Well, what can college students actually do? The solution is to open a brokerage account. Choose a low-cost index fund. Invest consistently each month and stay invested long-term. It's simple, but consistency over time is what builds wealth. And I just have here 3 brokerage that can help you to open, or that you can open up. Fidelity, Charles Schwab, and Vanguard, they're very, very reliable. Now, what is the call to action? So here's my challenge for you all. Before the semester ends, even if it's just $25, not after graduation, not once you get a real job, time is your greatest financial asset. And the earlier you use it, the more powerful it becomes. To conclude, time is the most valuable financial tool we have as young adults. Small investments can grow dramatically over decades. Waiting has permanent consequences. The best time to start investing was yesterday. The second best time is today. Thank you all very much. In this presentation, I used logos or a logical appeal through several slides. On slide 2, I showed real numerical growth using specific investments and a 7% return. On slides 5 and 6, I explained compound interest and also the cost of waiting. And on slide 8, I referenced historical market data. These logical comparisons and statistics strengthen the argument by relying on evidence rather than an opinion. Now we go to ethos. I use ethos, which establishes the credibility of what I'm saying. On slide 4, I cited research from the FIRA, Investor Education Foundation. On slide 6, I referenced the U.S. Securities and Exchange Commissions for explanations of compound interest. And on slide 8, I used data from S&P Dow Jones Indices. And now we go to pathos. Finally, I use pathos or emotional appeal. On slide 2, the visual growth of the investment creates excitement and motivation for the viewer. And on slide 5 and 9, I emphasize the idea that lost time cannot be recovered, which creates urgency. And on slide 11 and 12, I appealed to the desire for financial independence and stability. And these elements encourage action rather than delay. Thank you very much.